At this point, Impervious Travel Mugs has gone through, they've calculated all their variances, they've booked them in their journal using a standard costing system, made temporary accounts for all of those variances, etc. Well, that's information that managers are going to want to know about so they can help make managerial decisions to make Impervious the best company they can possibly be. And I don't think any manager wants to go through and have to peruse through our calculations and through our journals. That's not the way accountants convey information. They convey it in the form of financial statements, and that's what we're going to do. Impervious's accounting staff is going to prepare a standard costing income statement so they can hand it to managers, and managers have a nice tidy place to look for all of their different cost variances, efficiency variances, etc., so they can manage by exception. They can find the biggest variances and figure out a course of action that's going to fix it. So the first thing we're going to do is we're going to report our sales revenue at standard. The amount of sales revenue that Impervious expected to experience based upon the number of units that it moved and its standard selling price. And that information is provided to us in our info. It says down here that our budgeted sales revenue for this volume was $200,000. Well, that's not what we actually had. I'm going to skip a line down here, and I'm going to see that our actual sales revenue for the period, according to our information, was $208,000, which means that we had $8,000 more sales revenue than we were proposing we should have given the number of units that we made and sold. That is a favorable sales revenue variance. Next up, we got to subtract from our actual sales revenue what our actual COGS was to figure out our actual gross profit. How do I figure out what our COGS is at standard? It is what should have been for all of the different inventorial costs that we had during the period. If I go to our calculations over here, I see that we should have spent $45,000 on materials. We should have spent $75,000 on labor. We should have incurred $20,000 worth of variable overhead if we hit all our overhead standards. And we should have incurred $22,500 worth of fixed overhead. And that adds up to $162,500. So if we hit all of our standards, the quantity of materials that went into each mug, the price that we paid for those materials, the quantity of labor that went into each mug, the price we paid for labor, anything to do with our driver and our overhead allocation rates, like we hit everything perfectly. We should have had $162,500 worth of inventoriable cost go into goods which got sold during the period. That's obviously not what happened because we have a bunch of variances. What variances do we have? Well, we have a direct materials price variance. What was that? I can find that in my calculations. Our direct materials price variance was a $1,550 favorable variance. We have a direct materials efficiency variance. If we go to our calculations again, we had a $1,500 unfavorable efficiency variance. We had a direct labor price variance. My equals, go back to my calculations one more time. Our direct labor price variance was $1,028, and it was unfavorable. We had a direct labor efficiency variance that was unfavorable in the sum of $2,100. I'm going to bring that number on over to our standard cost income statement. We had a VOH, a variable overhead spending variance, which according to our calculations was unfavorable by $400. We had a VOH efficiency variance, which according to our calculations was unfavorable by $560. We had a an FOH spending variance, which according to our calculations was unfavorable in the amount of $800. We had a fixed overhead production volume variance of $500, and it was unfavorable. And if we add all that up, we get a sum of $5,338. Direct materials price variance is reducing our cost of goods sold, and it should because it is favorable. We paid less per pound of material than we thought we were going to. All of our other variances are all unfavorable. We had to buy more materials. We paid more per hour for labor. Our workers took more labor hours. The things that go into variable overhead increased in rate. We had to use more of the driver for variable overhead. The things that we spend on that we consider to be fixed ended up being more expensive than we thought they were going to be. And we needed to use more of the driver that we used to allocate that out during the period. All of those things caused costs which were bad for our bottom line. They are unfavorable variances, and since we're adjusting COGS, they should be increasing cost of goods sold. So on your standard cost income statement, favorable variances are negative, unfavorable variances are positive. And what do we have here? Well, we have now that yes, we should have recorded cost of goods sold of $162,500. But things didn't really go according to plan. We had a whole lot of variances, which resulted in an overall net, if you will, unfavorable variance of $5,338 to our cost of goods sold. So our cost of goods sold, in terms of what we actually paid for our inventoriable cost during the period that went into inventory that we actually sold, was $167,838. And since we actually had $208,000 in revenue from the sale of goods, which actually cost us $167,838 to sell, our margin, our gross profit, was $40,162. We've got one more thing to subtract out, and that's all of the costs that we incurred during the period, which couldn't be inventory because we're trying to get to our operating income here. I'm going to hit equals. I'm going to make this negative. I'm going to go to my info, and I'm going to see that our actual non-manufacturing costs were $25,162 during the period. So if we had a margin of $40,162 just from markup that was there and available to cover all of the costs that we had to pay that we couldn't inventory, and we had $25,162 of those period costs, of those non-manufacturing costs, that means that Impervious travel mugs operating income was $15,000 during the period. So now we can hand this to a manager who does management by exception. He's going to look at the biggest variances that we have. And the biggest one that we have is direct labor efficiency variance. This is going to tell the manager to go to the production supervisor and say, why did it take so many hours above what we expected to make these mugs? We have a big direct materials price variance. That one's favorable, but it's still worth going to the purchasing manager and saying, how do we get such a good discount? Are we getting the proper quality metal? Because that could be directly tied to our third biggest variance, which we had a very unfavorable direct material efficiency variance. Is it possible, in this case, that we bought metal from a vendor we don't usually buy from to make these travel mugs, and it was not of the quality that we expected, which resulted in us having to use more of it during the period to make up for portions of that purchase which might not have been in a suitable condition to turn into impervious travel mugs?